The U.S. stock market experienced a highly volatile week, with major indices diverging in performance. The Federal Reserve's policies, economic data, and earnings reports from major tech companies played a crucial role in shaping investor sentiment. In this video, we'll break down the overall market performance, key stock movements, economic indicators, and investment strategies for the coming week. The Dow Jones Industrial Average managed to edge up by approximately 0.2%, supported by its value-oriented components. However, the S&P 500 declined between 1% and 2%, while the Nasdaq Composite plunged 3.4%, marking its worst weekly performance. So far this year, the sell-off in growth and tech stocks erased Nasdaq's year-to-date gains, bringing its performance into negative territory. Sector rotation was evident as investors moved towards defensive stocks. Financials, plus 2.0%, real estate, plus 1.7%, and consumer staples, plus 0.6%, outperformed, benefiting from investor demand for stability. On the other hand, technology, 5.1%, and consumer discretionary, 3.0%, sectors suffered heavy losses as investors pulled out of high-growth stocks. Throughout the week, the S&P 500 saw daily changes of 0.50%, 0.47%, plus 0.01%, 1.59%, and plus 1.59% from Monday to Friday. Thursday's sharp decline was triggered by growth concerns and disappointing tech earnings, but stocks rebounded on Friday, after a lower-than-expected inflation report eased interest rate worries. The Federal Reserve remained at the center of market discussions as economic data unfolded. Early in the week, slowing growth concerns led to increased bond buying, pushing Treasury yields lower. The 10-year Treasury yield declined from 4.29% to 4.21% by Friday. A mild inflation report strengthened investor expectations that the Fed might pause or cut interest rates later in 2025. The core PCE inflation gauge met forecasts, reinforcing the Fed's patient stance. As a result, markets fully priced in a 0.25% rate cut for July, moving up expectations from the previously anticipated September timeline. Tech stocks were at the center of this week's volatility. The Nasdaq's decline was led by sell-offs in major growth stocks, although some managed to recover by the end of the week. Apple shares declined early in the week, but rebounded slightly on Friday, ending with a modest weekly loss. Microsoft finished slightly lower after news of data center lease cancellations, raising questions about its cloud expansion strategy. Tesla had a rough week, dropping over 8% on Tuesday alone and ending the week down approximately 13% due to concerns over demand and increasing competition. NVIDIA's highly anticipated earnings beat expectations, but the stock still plunged 8.5% on Thursday as profit-taking set in. Despite a 4% rebound on Friday, NVIDIA ended the week down 5% overall. Both Alphabet, the parent company of Google, and Amazon faced a rough trading week, reflecting the broader weakness in tech stocks. Without major earnings releases, their stock movements closely followed the Nasdaq's trajectory. Both companies saw declines of several percentage points by Thursday but managed to recover slightly on Friday, each rising around 1% to 2% as overall tech sentiment improved. Amazon continues to be a key focus for investors, particularly regarding cloud spending trends. AWS, Amazon's cloud business, remains a major revenue driver, and any shifts in enterprise cloud adoption could impact the company's valuation. Meanwhile, Alphabet is being closely watched for digital advertising trends, as concerns over ad revenue and AI competition persist. This week's market action was driven more by macroeconomic factors than company-specific news. However, investors remain cautious about the long-term outlook for these internet commerce giants amid evolving market conditions. Meta, the parent company of Facebook, had a volatile week. The stock declined along with other large-cap tech names, slipping about 1.6% on Tuesday. However, one of the biggest headlines of the week was Meta's reported consideration of a massive $200 billion investment in AI infrastructure and research. This news reinforced Meta's commitment to AI, not just for enhancing its social platforms, but also for fueling its metaverse ambitions. While this announcement was seen as a bullish signal for Meta's long-term AI prospects, some investors expressed concerns about the potential costs and impact on profit margins. As a result, Meta's stock ended the week slightly down, despite a Friday bounce of over 1%. Overall, the mixed reaction to Meta's AI investment highlights the ongoing tension between aggressive innovation spending and shareholder expectations for profitability. Salesforce, a key player in enterprise cloud software and a Dow component, struggled this week. The company's stock fell nearly 4% on Thursday after issuing a weaker-than-expected earnings outlook. This disappointed investors who were hoping for stronger guidance given the company's recent push into AI-powered CRM solutions. Beyond Salesforce, the broader enterprise software sector also faced challenges. The company's cautious outlook signaled potential softness in corporate IT spending, causing a ripple effect on similar firms. Meanwhile, Broadcom, another major cloud and AI-related stock, slid nearly 7% in sympathy with NVIDIA's post-earnings decline. Despite these challenges, defensive tech names like Cisco and certain SaaS companies fared better, benefiting from their more stable revenue models. The market remains watchful for signs of stabilization in enterprise software demand. This week's market saw several key stock moves that caught investors' attention. While the major indices faced volatility, certain individual stocks either soared or suffered due to earnings, macroeconomic trends, and sector rotations. Despite the overall market struggles, some stocks stood out with strong gains. AES Corp. AES, a utilities and renewable energy firm, surged 11.7% on Friday after posting better-than-expected earnings and providing a robust outlook. The company attributed its growth to booming energy demand from AI data centers and new manufacturing plants. AES also announced efforts to onshore its solar and battery supply chain to mitigate tariff risks, a move that was well received by investors. Another winner was Edison International, EIX, which climbed about 6% after the California utility reported that a state wildfire insurance fund would protect it from massive liabilities. Meanwhile, Erie Indemnity, Erie, an insurance company, jumped 5.7% as its earnings outperformed expectations due to strong operating and investment income. These idiosyncratic winners stood out during an otherwise tough week, showcasing that company-specific catalysts can still drive upside, even in a choppy market. On the downside, semiconductor and AI-related stocks were among the hardest hit. Supermicrocomputer, SMCI, a server maker closely tied to NVIDIA's ecosystem, plunged 16% on Thursday. SMCI had been a high flyer due to AI hardware demand, but NVIDIA's less-than-stellar earnings report led to a rapid sentiment reversal. Similarly, the iShares Semiconductor ETF, SOXX, fell nearly 6% in one day, with stocks like Marvell, MRVL, ON Semiconductor, ON, and Micron, MU, all suffering steep declines. The AI-linked utilities sector also took a hit, with Vistra Energy, VST, dropping 12% and Constellation Energy, CEG, falling 8% as the AI-fueled rally in power stocks cooled off. In the PC sector, HP Inc., or HPQ, slid nearly 7% on Friday, after issuing disappointing forward guidance, while Dell Technologies, Dell, dropped around 5% despite an earnings beat. Investors debated whether these declines represented a buying opportunity or signaled further downside risk. Social media platforms were buzzing with discussions about the tech sell-off. On Reddit's IR Stocks and R Wall Street Bets, NVIDIA's earnings report sparked thousands of comments, with users debating whether institutional profit-taking was behind the stock's post-earnings drop. Tesla remained a trending ticker as memes circulated about its market cap, slipping below $1 trillion. Opinions were split between buy-the-dip supporters and skeptics who warned that further downside was likely as Tesla's valuation catches up with reality. Palantir, PLTR, was another stock that dominated Reddit discussions. The stock tumbled about 13% this week after a euphoric run, with some users citing potential U.S. government budget cuts affecting Palantir's business. While some traders saw this as a major red flag, others viewed it as a rare buying opportunity in an AI powerhouse. Cryptocurrency also had a wild week, with Bitcoin tumbling nearly 20% from its all-time high last month, briefly dipping to around $78,000. The crypto Twitter community debated whether this was a routine pullback or a sign of waning momentum after last month's surge, fueled by regulatory optimism and political factors. By the end of the week, however, sentiment on social media shifted slightly more positive. Many traders pointed out that market pullbacks can be healthy and necessary for long-term stability. The phrase, "buy the dip," was a trending topic across Twitter and Reddit, highlighting the ongoing debate over whether the worst is over or if further volatility lies ahead. This week, the market experienced several brief but notable shifts in response to key news events. Early on, weak consumer confidence data, coupled with Walmart's cautious outlook on consumer spending, raised concerns about a potential slowdown. Midweek, financial stocks, including Goldman Sachs and J.P. Morgan, declined by more than 1%, fueling recession worries and signaling early warnings from cyclical sectors. On the geopolitical front, a significant development occurred on Friday when former President Trump met with Ukraine's President Zelensky. The meeting took an unexpected turn, with Trump and Vice President J.D. Vance reportedly arguing with Zelensky. As a result, a much-anticipated mineral rights deal, tied to ceasefire negotiations, was left unsigned. While this event did not directly impact the markets, it contributed to the broader backdrop of geopolitical uncertainty and sparked widespread discussion. Overall, the week was marked by a range of hot topics, from tariffs and tech earnings to trending tickers, making it one of the most eventful weeks of 2025 so far. This week, a series of economic data releases provided a snapshot of the U.S. economy, shaping expectations for Federal Reserve policy. The data was mixed, with encouraging signs of inflation cooling, but some concerning signals regarding consumer confidence and growth momentum. The Personal Consumption Expenditures, PCE, price index, the Fed's preferred inflation measure, delivered good news. In January, headline PCE rose by 0.3% month-over-month, while core PCE, excluding food and energy, also climbed 0.3%, aligning with expectations. More notably, year-over-year core PCE inflation slowed to 2.6%, the lowest annual rate since early 2021. This marked the first significant cooling of inflation in 4 months, suggesting that price pressures are easing toward the Fed's 2% target range. As a result, the report alleviated concerns that the Fed might need to tighten policy further. Instead, it strengthened the case for the Fed to hold rates steady or even consider cuts later in 2025. Bond markets reacted positively, as seen in falling yields and rising Treasury prices. If you still want to receive U.S. stock information next week, please subscribe and hit the alarm button. Thank you for watching and see you next week.